Hi, everyone. Welcome to this special webinar where we dissect the latest US CPI data, yesterday's CPI data, and also yesterday's FOMC meeting. I think it was the first time since 2020 that we've had both the Fed and the CPI on the same day. Whilst I just let you, first of all, have a look at the disclaimer, I'll just run through what we would like to get through in the next 30, 40 minutes or so. We'll first of all check out the CPI data, which obviously kicked off things yesterday. We'll have a look at a few charts and highlight a few observations that we have on that really important data, which really kicked off the market. Before then, looking at the Fed, the FOMC meeting, that was late last night, UK time. And we'll look at, again, a few charts, a few significant numbers, as well as, of course, the dot plot and all our observations, thoughts around that, the implications for that, as well as then looking forward slightly, what to look at going forward, especially with the data coming out and potentially what happens to CPI and as well what the Fed are thinking. After that, then we'll finish up with the sort of market reaction that we've seen both yesterday, of course, and today. We'll look at stocks and we'll also look at the main currency pairs, the FX majors. Okay, let's get straight to it then. As I said, here are the main topics that we'll be looking at. And firstly, we'll kick off with the inflation data out of yesterday, out of the US, which, as I say, really kicked off the market, kicked off a big, decent reaction in markets after this release. We did have far too high inflation prints at the start of the year. Of course, if you remember, the first 3 months of the year were really an upside. We saw upside surprises in all of those three releases. But now really we're seeing some better readings, and it was actually the second straight month of lower core CPI. That's what really policymakers at the Fed are concentrated on. If you think about the April core PCE deflator, which is the Fed's favored inflation gauge, that came in at 0.2%. And yesterday's core CPI for May, that repeated the fate, really. It came in at 0.2% actually versus 0.3%. I've just got that figure in here, actually, because if you look at it down to 3 decimal places, it's even better, actually. It came in at 0.163% month on month, which is the lowest since August 2021. Really interesting, and I've pointed this out before in some of our webinars, really, that we're going down to sort of 2, 3 decimal places even. And I think even one of the Fed officials talked about that as well yesterday. But in any event, that's what we're doing. That's what the market likes to focus on. So it is important. And therefore, we're highlighting that the actual 0.2 reading was actually 0.163, which again excited the market. At the same time, headline CPI, that came in flat, 0 month on month versus the consensus 0.1%. And that was below every single forecast. So year on year, these are these big numbers here, of course. So the headline, that slowed to 3.3 from 3.4% previously. And then the core, that slowed to 3.4 from 3.6%, actually. 3.5, I think, in the end. So 1/10 lower than forecast. But really the focus, as I said, on the month-on-month run rate, and really those outcomes massively boosted really the chances of a September start point for rate cuts really quite considerably. I want to point out another measure that Fed officials do look at. That's the super core measure. So that's core services, less housing. And that printed the first negative month-on-month reading, negative 0.04, first negative reading since September 2021. So again, really interesting print and of note for markets, of note for economists as well. I should say that recent readings have been stronger than normal. So really, we do need a series of those to be considering that sort of trend-like disinflation in that super core measure. But All in all, decent numbers. I'll just look at some of the details then. Core services that continued to rise last month, although not as swiftly as before. But a fall in energy prices, really, that was enough to counterbalance, if you like, the overall effect of that and bring the overall number virtually to zero. That doesn't happen often, we should say. So the zero print hasn't happened actually since the pandemic. And again, nobody expected that to happen last month. Not a single economist polled in advance by Bloomberg saw that coming. And another strong sign that inflation is coming down, is hurting less, if you like. I've got a chart in here. Actually, this chart. Actually, I should have brought up before. You can just see it's from an investment bank, ING, actually. But yeah, you can see the bar chart, really, the month-on-month readings. So again, 0.163, so below that, what, 0.2, and that thick line there is the 0.17, which is really what economists think is needed month on month for quite a few months to bring the inflation target down to 2%. So a positive reading, definitely, or an encouraging reading, I should say. And then you can just see the 3-month annualized number, that orange line, which is now turning lower again, having popped up, like we mentioned, from January through to March, moving higher. Now you can see quite sharply lower, really, and interesting on that scale. And then the grey line is the year-on-year number, which obviously hit 3.4%. So again, nice sort of disinflation trend of falling prices. As I mentioned, though, and if we do get into some of the little detail, which really we should be looking at, if you're really into this kind of these numbers, and bearing in mind how significant they are, then some of these little things to look at, hopefully will help you guys when you're trading and picking trades for sure, and just figuring out what the market is thinking and where it is going. But this chart here, core goods, which excludes food and energy. So the category really that drove the inflation spike in 2021 and 2022, that registered its biggest year-on-year deflation. So prices actually came down in 2 decades. And now we're actually touching a 20-year low in this. Just with some of those details, then there was a big drop in airfares. That did some heavy lifting, certainly for the soft core inflation print. And then vehicle insurance, that also dropped. That's been an engine of inflation pressures in recent months. So really yesterday's development, really quite a relief, even though it is year on year still quite elevated. Should caveat everything, because everything I've said really very encouraging for policymakers, but there are some lingering strengths in pricing power. So used car prices, for example, they rose, although auction prices have come down more recently, and their care prices, they also remain relatively hot, rising 0.5%, I think. Housing numbers, though, they are really key. They aren't really showing any softening, with owners' equivalent rent holding at 0.4% month on month for the 4th straight month, and primary rents as well doing the same. There's been a big focus on rents and these costs because they are a big portion of the basket in the CPI basket, if you like. And really, if you think about it, higher interest rates should affect house prices and rents quite directly, although there is a lag. And certainly then the market's sort of post-pandemic bottlenecks seem to be stopping those high interest rates from happening directly. To account for the ongoing questions over measuring sort of shelter prices, actually, it was interesting. Chair Powell and his colleagues chose to focus, as I mentioned, on that so-called super core of services, excluding housing, and a measure particularly for the ongoing, a measure particularly which is influenced by wages. The good news really is that both those indices, as I kind of mentioned, fell last month just a little bit. The bad news is that they're probably still too high for comfort for policymakers, and that is probably the issue at the moment. Nonetheless, all other components, they were in the 0 to zero point 0.2 range, which is really what we want to see, what markets want to see, and policymakers ties in really with what the Fed wrote about price pressures actually in the most recent beige book as well. Given all of this, then core PCE that could be very soft now going forward with its due to its lower weight on shelter and then higher weight on core services. And they seem to have come down quite sharply. So interesting. People already looking towards that core PCE number, which is at the end of the month, potentially could print with a zero point 0.1 handle, which it hasn't done, but would be the lowest in about 6 months or even lower. So yes, all in. I'm just checking what chart we've got. All in then. Yes, all round softer CPI, breadth was lower, less aggressive price hikes across the board. I think somebody said that the basket, 32% of the basket was running at greater than 0.4% month on month. That's against 38% in April. And then 13%, 1.3 was greater than 1% month on month. And that was 23% in April. So a lot of this driven by core services, but certainly an encouraging report. If we now go to the Fed meeting, of course, and also the dot plot, we had this in here actually on our Monday webinar, but I thought I'd just keep it in there just because that's what we were looking at and some of the main numbers you can see for what markets would look at, and then obviously as well policymakers before then deciding on what they were going to do. Um, But obviously, yes, the Fed held interest rates steady at that 23-year high of 5.25 to 5.5%. That was widely expected, of course. But as officials, really, the most important thing was they projected only a single quarter percentage point reduction for the year amid rising estimates for what it will take to keep inflation in check. The markdown in the outlook for rate cuts from 3 25 basis point cuts seen in the Fed's March dot plot median projection was made despite the central bank's acknowledgement in its new policy statement of modest further progress towards its 2% target. That was an upgrade from its May statement, a March statement, sorry, a marginally more dovish. Otherwise, there were kind of few changes to the statement. So it was all about the dot plot. We've got that here, and you can see really expectations were that the policymakers would reduce their median dot plot. That would come in at from 3 rate cuts to 2 rate cuts in 2024. One was the median projection, although it was a close call on the votes between either 1 or 2 in 2024. So you can see here 7 officials saw just 1 cut, 8 were seeing 2 cuts, and then 4 were no cuts. So really the plurality, if you like, of the votes was therefore in favor of reducing the policy rate by 50 basis points this year, and a really healthy majority saw at least 1 cut. Just casting our minds back as well, interesting in a way. Previously in March, it was 2 members opting for no change, 2 for 1 cut, 5 for 2 cuts, and 9 for 3 cuts. And actually, the outlier was 1 for 4 cuts, so 100 basis points of cuts. But 2025, this time around, they saw officials saw a median increase to 4 cuts from 3 previously. So the median dot plot 4.1% for 3.9 in March, while the 2026 dot was unchanged at 3.1%. So the net impact of this for the next 18 months at least was essentially a reduction of 1 less 25 basis point cut. But also note, and if you can see on here, certainly projected rates still moving upwards from previously, but also there is still a wide range of opinion. It coincided, all of these median dot plots, of course, as well, with, interestingly, an increase to 2.8% in the estimated long run or neutral rate of interest. That's actually the highest since 2019, coming from 2.6% in March, which was an uplift from 2.5%. Really indicates policymakers kind of concluded the economy does need more restraint in order to really finish the battle against rising prices. That said, over the long run, 2.8% neutral Fed funds rate is perhaps still too low if you think about the environment of basically ongoing loose fiscal policy, pretty much irrespective of who wins the November US election. We also have demographic change and then, of course, ongoing deglobalization trends. So, interesting that's probably a wider sort of thought, wider thinking around that neutral rate. But then, as well, interestingly, in the press conference, actually, Chair Powell dismissed the sort of R star as a concept, really saying, I think he said, not a number that lends itself to being precisely estimated. Um, Ultimately, then, for the Fed, the rate cut view was more hawkish than in the March summary of economic projections, but the details, well, perhaps were sort of perhaps moderated that hawkishness in some way. So there were growth and unemployment rate projections. They offered some insight into how the Fed views the current state, of course, and expected evolution of the economy this year. So other than moving the PCE, so the inflation forecast higher, so core went from 2.8%. To 2.8% from 2.6% by year end. Growth and unemployment projections were unchanged. Though again, interesting, pretty upbeat GDP forecast, Q4 2.1%, whereas the market consensus is 1.7, while the unemployment rate 4% they figured at the end of this year, and we're already there. So kind of interesting, and especially say that inflation projection is kind of inconsistent, if you like, in or there is inconsistency really in the 2024 dot plot as a collection because rate cuts are still expected, even just one. Yet inflation is seen rising slightly by year end, and then with growth and unemployment unchanged. So, kind of in other words, the median committee member really sees lower rates yet higher inflation and no slowing in the economy. So you kind of figure how that holds together, really. And I think Powell was actually asked that question and he didn't really have a good answer. So, yeah, interesting sort of inconsistency, really, with some of these projections. And I know that there is some skepticism over them generally going forward. But anyway, that's what we work with. This is just a different view of those dot plots. Um, and yes, some interesting questions to be answered potentially going forward. Okay, moving on to the next section, what to know really going forward. Well, keeping on Powell, of course, he sounded a touch, well, more dovish than the projections really implied as well. I've sort of mentioned that with those the SEP, the summary of economic projections, but Powell slightly gave some well words, hints, a touch more dovish than, as I say, than the dot plot. Certainly in that move. Policy, of course, will be driven by data. He said that a couple of times. Indeed, he said the projections aren't a plan and they can adjust with the Fed ready to respond either way. Really left the Fed's options pretty wide open, and the Fed will remain reactive going forward, of course, although they need this, of course, this off-stated sort of need for greater confidence. Certainly, this is what we had before actually Fed funds pricing. Before the meeting, I thought I'd leave that in. We had showed you that on Monday at the week ahead webinar. But markets were expecting less than 50 basis points of rate cuts, slightly less. But now this is sort of a more updated chart, if you like, after the meeting. So you can just see now markets expect more rate cuts than the Fed. So if you think the Fed only expects 25 basis points this year, markets seemingly above that, at least a cut and a half, I'd say. And you can just see the difference there slightly between Tuesday and then Wednesday. So the sort of blue line is Wednesday, and being below the orange line. So more rate cuts, if you like. And then you've got also the March dot as opposed to then less cuts. So that dot going higher and rates seemingly being higher as at year end. That just being the different Fed meetings in March and June. Uh, Ultimately, though, of course, policy is still restrictive at 5.25 to 5.5%, especially when neutral, say, is around that 2.8%, 3% level. And if you think about it, the Fed really, they don't want to cause a recession. And if data allow, then certainly they would be keen, you would think, to make policy less restrictive. Markets, as I said, they see a rate cut in September. Futures giving that around a sort of 60, just above a 60% chance, I think, the last time I looked. And that all means then certainly inflation data, so CPI, of course, PCE, which we get at the end of the month, wages and other price measures, really, they will continue to be the most important data for gauging the future course of rates. And it also means, as I've mentioned, about these core prints being sort of 0.2% and below, really, over the next 2 or 3 releases, really, then to really cement a rate cut. Also, we probably need to see labour market slack as well. So in the labour market, potentially the unemployment rate above 4%, with evidence certainly of wages cooling as well. And then similarly, softer consumer spending would be an important tick, really. That's been the main engine of growth in the US for some time, and historically. So really, again, weak spending data and also GDP revisions would be a good tick box going forward. We've just got the non-farm payroll sort of chart in here, just showing you how, yeah, especially the last print was pretty strong, but the 3-month average kind of picking up slightly, but it's the unemployment rate as well, which is potentially key and potentially then bringing down those job gains slightly towards a sort of a more of a balance between sort of supply and demand in the labor market. Just before we get to current market analysis, then really, yes, overall, it seems the dovish message from the CPI print was more powerful than the slightly hawkish one from the Fed. Market reaction really to the inflation report not being close to undone really after the FOMC. Market now, as it was when rates were rising, actually is more dovish, as I've mentioned, than the Fed. And as that chart showed earlier, that one. And Tuesday's really end of day federal funds rate curve actually sees about, well, actually, yeah, more than a cut and a half now, closer to 2 full cuts by the end of the year. And really, then it's all about the data going forward, giving greater confidence that the Fed needs to potentially cut rates. For market analysis, I'll just bring up this chart now, actually, first of all, which hopefully, yeah, I'll get to shortly. But just before I do, just generally, just checking what you can see, actually, generally, yeah, well, yesterday, global equities, really, they saw a big rise. Not due to robust demand data, really, but that really softer than expected CPI data. That's what sparked everything. And then trumped, as I said, that slightly more hawkish dot plot, certainly, which was unexpected. 1 versus 2 probably was expected previously. It kind of superficially appeared as like a classic sort of risk on rally, equities rising across regions, cyclicals were outperforming value. They still underperformed as a sector, growth by around 1% as yields really collapsed after that US CPI data. And it does again show how important inflation is still for investors. And part of that rotation yesterday also refers to the high, really, and still growing appetite for tech stocks. And this is why I've got this chart in here. It's also evident in really today's futures, which are again pushing north tech leading significantly. Yesterday, of course, the Dow fell by 0.1%, but the S&P rose by 0.9, Nasdaq by 0.15%, and again, futures showing strong gains today as well. The S&P, that topped 5,400 for the first time actually on Wednesday. That's really because the US kind of again hitting this sort of Goldilocks phase, if you like. So not too hot, not too cold. The economy still looking robust while inflation seemingly is heading south. That's really an ideal environment for stocks. So you've got the economy strong enough to spur on companies, but then weak enough to push the Fed towards rate cuts, which would then, of course, reduce borrowing costs and increase stock values. Of course, it could all change. On the one hand, you've got a sort of hardy economy, if you like, which could keep inflation simmering. But then on the other, drop in inflation possibly then signals a faltering economy. Those are sort of broader questions. What is clear as well, of course, is that tech and then the Magnificent Seven still, probably ex Tesla, which is no longer, of course, one of the seven biggest stocks in the US by market cap. Those collection of stocks continue to power ahead. Here we've got that nice chart. Actually, it's from Bloomberg, from John Author's daily. He writes a great daily email newsletter. He works at Bloomberg, but this chart from him just shows you obviously the rise, rebasing to 100. Excuse me, of the seven, relative to the other 493 in the S&P 500. So you had ChatGPT, of course, in November 2022. And then we've just had another big boost, really, by Apple's debut of Apple Intelligence, where Apple actually briefly overtook Microsoft yesterday as the biggest market cap out there. Interestingly as well, he points out actually Magnificent Seven, who account for just 1.4% of companies in the S&P 500. They're now, I think, at the biggest market cap they've ever been, 32.3% of market cap. And that share has almost doubled since the start of the pandemic. So yeah, lower bond yields, of course, they've been helping recently, and then certainly anything AI in it really is trumping everything else then. But you have to kind of remember this kind of amazing growth is kind of being made at the expense of all others. So I think again, since 2000, Magnificent growth tops 400%. But then if you think about an equally weighted, say, Russell 2000, smaller companies, those have gained just 17.17%. So yeah, that's sort of stock wise, sort of tallying in, going a bit wider than the Fed, but still interesting as they continue to go higher. If we just look at some of the price charts now, actually, which you can see here. This is the S&P 500, and you can see, yeah, futures up 1.3%. So another new high, overbought on the daily, overbought on the weekly. Really nice breakout there, though, sort of consolidation around the previous highs and then a big push higher this week. Yeah, overbought though. Even touching now the monthly, another nice breakout, really consolidating and then pushing higher. But we are, I've got the Keltner channels on here actually, so we're up through that higher band. Doesn't mean, like you can see here, that we can't continue to push up on that higher band. But at some point, it does warn of a correction, because if you tally it with other measures, for example, the monthly RSI, as I said, the weekly RSI, the daily RSI, then potentially there is a correction due, but tough to call at the moment. Nasdaq similar, heading for 20,000. Really, you can see futures there closing on 20,000, 19,888 due to open, up 2%. Then the futures, incredible run really. And I was just looking at this earlier. Actually, the move from 19,000 to 20,000 potentially just a matter of days. So incredible momentum, bullish momentum. But again, possible correction coming just technically if you look at the overbought nature of this upside breakout. Contrast this with the Dow, of course. You can see futures are up in the Dow. but not certainly as much as the Nasdaq being up 2% or so. And you can just see, oh, well, we'll go to the cash actually, and just this tepid really bounce after this strong sell-off. Obviously, a very different picture for these 30 stocks, which, yeah, some say is kind of not representative, of course, of the wider market. But then it does have Apple in, but less, of course, tech stocks in amongst the 30. Okay, we'll just briefly then also look at currencies as well. And the dollar, of course, first up. Net, really, there's the candlestick, which hopefully is clear to you guys. So you can see yesterday's move, significant move lower. And this morning, of course, we're bid actually, but we're net lower, of course, since after the CPI data we made up. Well, you can see yesterday made up sort of around half the losses during and after the FOMC and then Powell's press conference. Just touching on that, then, of course, he was expected to be dovish as he had been over the prior four meetings, but probably felt, those new inflation forecasts and dot plot changes that was tricky to be as dovish as he wanted to be. Probably the soft CPI data, though, that could possibly set the tone going forward near term for the dollar. Interesting, though, we are getting some buying, as I said today. Always interesting the day after these big risk events, what the follow through is. And at the moment, there is no follow through selling. So the Fed is slightly getting its own back, if you like, over the CPI data. But yeah, will be interesting going forward for sure. Um, Certainly today, the market will be examining the PPI data out shortly for clues about then the May core PCE inflation data released on the end of the month, 28th of June, actually, that is, where really another 0.2% month on month reading presumably would add to the Fed's confidence in easing. PPI data, certainly that feeds into the PCE data, so that will be watched today. Also interesting, I think, around the sort of divergence debate. That theme, which grabbed the headlines in April, really pushed the dollar to highs. Of course, US exceptionalism, that potentially might wane now. See investors really warming more to a convergence story, if you like. We've had cuts in the Eurozone, Canada, Switzerland, Sweden. So potentially then, if this data is changing in the US, the price data, of course, then the Fed follows suit. Certainly later this year, potentially September. And I think it's interesting, some yield differentials between different currencies, euro dollar, for example, that has narrowed really from sort of 160 basis points, I think it was the 2 year, to around sort of 130 now. So, yeah, interesting theme going forward. That is really whether this divergence becomes more of a convergence story, as I say, in the months ahead. We also get initial jobless claims out today, recently nudged up really slightly, adding to this sense of a cooling jobs market. Even as, of course, the latest non-farm payroll figure surprised to the upside. Certainly, those softer data could potentially help more high beta G10 currencies, if you like. So that would be sort of the Aussie, the Kiwi, Scandi currencies as well, potentially outperform. But that, of course, assumes US price data continues in the same direction as yesterday. And then those trends potentially can get a bit of a lift. If we look at the dollar, then you can see technically, yeah, the black line is the 200-day moving average. Hopefully this is quite clear for you guys. So we sort of touched that yesterday and went through that, as well as a fib level at 104.26. You can see that touch there, but then rebounded off that. I think this trend line is quite nice. This upward trend line, which we obviously fell through, and we're just playing around at the moment, and is proving, well, at the moment, potentially support. That blue line there, I'll just take off the Keltners. Is the 50-day moving average, so cut the upside a couple of times there, so potentially valid. acted as support previously over the last few months. And so support, then resistance. So watch that line. That's a 105.12, and then another fib level at 105.25. If we go to the euro, you can see we had a big pop higher, as with all the major currencies. They strengthened initially, obviously, on the CPI data, and then fell back on the Fed dot plot, really. 108.52 we got up to, but then pulled back to this fib level at 108.06. Also, we just got now the 200-day moving average, that black line, plus the 50-day, so 107.88 and then 107.76. So that's potentially a zone of support as well. I think interesting for, obviously, the Eurozone. Of course, we've got this political risk out of France, potentially out of Germany as well. There might be some uncertainty there as well, with the president stepping down potentially. And that obviously contrasted with the sort of data-driven dollar decline that we saw yesterday. So you might see this battle going forward could be quite messy, really, price action in euro dollar. As I say, going forward with this political risk uncertainty, always tricky to price, and then set against, of course, potentially softer dollar data as well. It might actually be worth looking at crosses in this event. So euro crosses is what I'm talking about. Say, for example, the euro Aussie, which if I just pull up here, just go to the weekly, you could see potentially, yeah, we're just moving down to this major support here from sort of December last year, around sort of 174 region or so. So if we do move lower, euro political risk premium sort of kicks in, and then you've got the RBA being pretty steadfast after, of course, the data overnight. Then potentially this really neat look downward bear channel continues. But again, 174 sort of region is very strong support. So that'll be interesting, and a nice sort of way to play this political risk in Europe, potentially over sort of euro dollar, specifically in the major. Cable, let's look at that briefly as well. So you can see the pop up to multi-week highs, really. 128, where were we? 128.60, the high before then pairing gains. 128 looks like a barrier. If you just pull it back, obviously we haven't spent very long above 128 recently. So yeah, looks like resistance. Next week will be interesting just to get to that. We have UK CPI data before then the Bank of England meeting. And potentially people looking at CPI following the US stance, really. A couple of softer prints, of course. The focus really is on sticky core services. And so that'll be watched near term. I did point out, and I have pointed out on the daily, actually, about euro sterling. That's been interesting, really, with this gap lower on Monday morning, with that French news, European election news, really, and just taking out that pretty strong support level around sort of 84, 92, 85. So we're now down below. Yeah, I chose the weekly chart on the daily commentary that we put out on the website, so you can just see it there. And as long as we don't regain that sort of 85 level, then yeah, we're looking at below 84, really being short down to this next very strong or very important long-term level, 83, low 83s, 83.39. That's in euro sterling. Just quickly, we'll look at dollar yen as well, because we've got the Bank of Japan meeting coming up, of course. So let's just go to the daily here. So you can see the move down lower in dollar yen, of course, with the move lower in yields. The 10-year Treasury yield always correlates highly with dollar yen, but then you can just see us now gaining a bid with this dollar bid, really, and potentially as well with, well, yields are off, actually, which is interesting, but yeah, the dollar is bid. So yeah, 158 region is very dangerous for more intervention, of course. I think there was 62 billion spent in May on that, and certainly the authorities really hoping it turns out like events in 2022. Cast your mind back when the major turned really sharply south as US rates cooled. That's certainly what they're hoping to do. or hoping that happens now. As for the Bank of Japan, that is Friday morning, tomorrow. In fact, they'll keep rates unchanged, but Governor Ada will likely signal further rate hikes going forward. July potentially signposted. I think consensus really expects an announcement about the start of quantitative tightening, with the Bank of Japan reducing its bond buying. But going forward, yeah, there has been rebounding inflation and retail sales plus stronger wages. So that really puts policy normalization in play as well. As I say, for dollar yen anyway, two-way risk is something authorities want to see. That's why they spent 62 billion, of course, on an intervention. So it just wasn't a one-way upward streak in dollar yen at least. So 158 is key, and then sort of 156 is the halfway point of this yen intervention high low, if you like. Yeah, that's a 156.03. Excuse me. Okay, I will wrap it up there. But hopefully that's been of use to everyone. I should have said, if you do have any questions, please do ask them along the way. Apologies a little bit late on that, but hopefully you are used to that now, having followed the weekly webinars and questions being asked there. But really hope that's been of use to everyone. Thank you so much for coming on to this special webinar. And please do follow us on social media, various channels, as well as I say, as the daily commentary we put up on the website. That has a breakdown, really a look at US markets after the US close. It has a look at the day ahead as well, and then a chart of the day as well. So, yes, thank you so much for coming on the call, and we will speak to you on Monday. Okay, take care.